Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, December 19th. The Fed announced a pretty hawkish cut yesterday and spoiled the Christmas optimism across the global financial markets. So the US indices closed deeply in the red yesterday. The US yields and the US dollar jumped, while crude oil reversed an early advance after the decision. Happily, the Bank of Japan didn't dare to go ahead with a rate hike today, while the Bank of England is expected to do just nothing at today's monetary policy meeting. But wait. Sometimes the truth is hard to say and even harder to hear. So that was one of these hard moments for the Fed and the markets yesterday when the Federal Reserve announced another 25 basis point cut as widely expected and as widely priced in, but hinted that there will be just about 2 interest rate cuts throughout next year. So the GDP forecast for this year and for the next were revised higher. The unemployment rate for the US was revised lower, and more importantly, the inflation projections from the Fed were sensibly higher this December compared to the September projections. So the verdict was quite clear from the Fed. They must slow down their interest rate cuts. But to hear it from Powell was quite unsettling, actually, because he said yesterday that they are at or near a point at which it will be appropriate to slow down the pace of further adjustments. But they have started cutting their interest rates just 3 months ago, guys, with a jumbo rate cut. So I think I have rarely seen a Federal Reserve team acting this erratic. It is hilarious. Now, obviously, that surprising and unusual lucidity moment from the Fed was a shocker for many market participants, of course. This is not what the Fed usually does, right? They don't usually disappoint the market to such extent. They generally talk and talk and talk before acting to prepare the market for the bad news. But this time around, it was a bit sudden, I reckon. So the market reaction was very aggressive indeed. The US 2-year yield spiked past the 4.35% level after the decision. The 10-year yield spiked past the 4.5% mark. The S&P 500 dropped nearly 3% yesterday. The Nasdaq 100's more rate sensitive and growth stocks tumbled 3.60%, and the Dow Jones Industrial Index smashed more than 2.5% yesterday, and such extended losses to more than 6% since the beginning of this December for the 10th straight session, apparently its longest losing streak since 1974. Now note that the Dow Jones Industrial Index has been diverging negatively from its technology-heavy peers since the beginning of this month of December, and that was obviously a sign of a returning concentration back to the technology stocks in the US. But this time, even the rising stars of the technology couldn't swim against the Fed tide. Broadcom just tumbled nearly 7% at yesterday's trading session after the Fed decision, while Nvidia lost 1.14%. Altogether, the Magnificent Seven stocks gave back a hefty 4.40% yesterday after the Federal Reserve's hawkish announcement, and investors are obviously asking, what's next? Well, the Fed may have, spoiled this year's Santa rally. That's the thing. We agree on it. And its latest hawkish shift could eventually trigger a deeper downside correction across the US equity markets, which have had 2 stellar years, basically thanks to the big technology stocks' incredible performance on AI. But filtering the big technology out, the S&P 493's performance was good, it was okay, but much less compared to the big technology. So these sectors, the non-technology sectors, were waiting for the Fed cuts to get a part of the pie, and we could eventually see this latest equity rally fade, unfortunately, before it expands further toward the non-technology pockets of the market. And speaking of technology, Micron tumbled 16% in the after-hours trading yesterday after they missed their second quarter revenue forecast by around $1 billion, and that despite strong orders for components used for AI. In the FX and commodities space, well, the US dollar obviously rallied aggressively across the board yesterday after the Fed announcement. The US dollar index jumped more than 1% yesterday, and gold tipped a toe below the $2,600 per ounce level and below its 100-day moving average. Obviously, higher US yields increased the opportunity cost of holding the non-interest bearing gold. Yet note that an accelerated sell-off and a prolonged weakness in the US equity markets and the global equity markets could eventually drive capital toward the safety of the yellow metal in the foreseeable future and give yellow metal support at the current levels. The euro dollar, on the other hand, tumbled to 103.44 level yesterday, obviously on the back of a sharp hawkish shift from the Federal Reserve at yesterday's announcement. And the bears here are now eyeing the parity as their next big target. But on the way, the 102 level should provide the last major support to the euro dollar. It is the 61.8% Fibonacci retracement on the post-pandemic rebound in the euro dollar and also the last important technical level before confirming the euro's deeper weakness against the US dollar toward parity. Elsewhere, the Bank of Japan maintained its monetary policy rate unchanged today, as expected, and all that. We have no interest in waiting before we increase interest rates further. Talk just happened to be completely empty yet again. Only one dude there out of 9 voted to hike the interest rates today. The other policymakers said that they needed more time to assess the risks from Donald Trump policies and also the wage outlook in Japan. As such, the dollar-yen rallied above the 155 level today, and the pair is supported by the sweet combination of more hawkish Federal Reserve and less hawkish Bank of Japan policy outlooks. Elsewhere, well, the Bank of England is the next major central bank that's going to announce its latest monetary policy verdict. That's going to be later today. The Brits, well, are not expected to make any changes at all to their rate policy at today's monetary policy meeting. The Bank of England had actually turned quite bearish. Remember, that was earlier this year before the autumn budget announcement. Because after the announcement, the higher spending plans from the UK government gave some cold feet to Mr. Bailey, who immediately stepped back from his more aggressive rate cut plans, remember? But the problem here is that the benefits of higher government spending next year will probably kick in after the pain of higher taxes to finance the spending. And the Bank of England may just have to give some support to the economy during this transition period without fueling inflation. So that's always a problem that started giving signs of heating up over the past 2 months. So it is all very much complicated for the Bank of England officials. As per sterling, cable was also hit yesterday, as everyone else, by a broadly stronger US dollar after the Fed decision, and a cautious stance from the Bank of England today may eventually slow down but not reverse its negative trend, as the UK's economy, which actually performed surprisingly well this year, could eventually feel the pinch of higher taxes, as I said before the benefits of improved growth, and that the pain before gain narrative could keep the sterling bulls on the sidelines, and that despite a less dovish stance from the Bank of England. The Bank of England is also expected to cut its interest rates only twice next year, by the way. So if you want to buy sterling against something, you could consider buying it against the euro, because the divergence between a cautiously dovish Bank of England and a dovish European Central Bank continues to back a deeper downside correction in the euro pound toward the 82 cents level. And finally, the Fed's hawkish shift dampened an early rebound that we saw in crude oil prices yesterday. The rebound had been actually supported by lower than expected US oil inventories last week, as announced by the EIA data, but the barrel of US crude slipped back to $70 per barrel level after the Fed decision. So the Fed's cautious stance Now, coupled with a weak demand outlook globally and ample global supply lend further strength to the oil bear. So we anticipate a range-bound trading within the $67 to $70 per barrel range before finding a fresh direction in oil prices. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.